Welcome back to Actual Investing and happy March, everyone. Today I have a new video series that I'm going to start doing called 5 on the 5th. So every 5th of the month, I'm going to talk about 5 different stocks that I think are compelling and give you a quick elevator pitch on each of those stocks. So every month you'll have 5 new stocks that you can add to your watch list or do some more research on, or if it's a stock you're already familiar with, then you can get a quick update on it and see what I think about it. So without further ado, let's just dive right into it. The first stock I want to talk about today is Incyte, ticker INCY. So this is a smaller pharmaceutical company. They're only a $13 billion market cap, which puts them on the low end of large cap. They have 2 main drugs right now. Jakafi is kind of their blockbuster drug, and it treats bone marrow and blood cancers. That doesn't treat bone marrow. It treats bone marrow cancer and blood cancers. I could have worded that better. I apologize for that. It's also known as myelofibrosis. And then they also have a drug called Opzelura, which treats eczema. It's a dermatology drug. So what I like about Incyte is they have really good financials. So right now they have $3.7 billion in cash with only $1.6 billion in debt. So really they could pay off their debt twice over and still have cash left over. They are very profitable, so they make $200 million in profit per quarter. So with pharmaceutical companies, most of the costs are associated with developing the drugs, but selling the actual drug, most of that is going to be pure profits. So as you can see, this company has gross margins of 93%. So they are highly profitable. They have, like I said, $200 million in profit per quarter, and that's what I like to see with already a great balance sheet. They can spend a lot of money acquiring growth or looking for that next blockbuster drug. They do have quite a robust pipeline, which I love to see. I'm not a biotech guy, so this is not my strong suit, but I do know to look at the pipeline and to find out if there's any candidates that are going to be promising and to look at the cash and the financials. So this is a company that I have invested in. I invested in it last month, and I think that they show a lot of promise. So something I like to see is that their R&D is only 47% of their gross margin, or their gross profit, I should say. So I love to see companies spending less than 50% on R&D. And I also like that their valuation is quite low at only 3 times annualized sales. They have $4 billion in annualized revenue, and their growth rate is nothing to write home about, but it is positive and it is beating inflation at 9.4%. So this company scores quite well. If you're new to the channel, I score on 4 metrics, and those are revenues, growth, valuation, and gross margins. So higher gross margins gives you a higher score. And each of these are out of 5, so the max score you can get is 20 for a 5 on each metric. So higher gross margins gets you a 5. Very high annualized revenue gets you a 5 because it's harder to grow a large revenue number than it is to grow a small revenue number. A lower valuation gets you 5, and then high revenue growth. So in order to get a 20, you'd have to have triple-digit revenue growth, 1 times price to annualized sales, 20 billion plus in annual revenue, and 90% gross margins. It's impossible. I've never seen a company with 20. Theoretically is possible, but it will never happen. So anyway, so that's Incyte. Let's talk about my next stock today, which is going to be Expedia. So you may know Expedia as the online travel agency, but they actually are quite a diversified travel company. I actually like Expedia more than Airbnb, and I've chosen to invest in EXPE stock over Airbnb stock. So Expedia owns Vrbo, which is the key competitor to Airbnb. Sure, Airbnb is much larger than Vrbo, but to me, if you invest in Expedia, you're investing in Vrbo as well as their other companies, including Hotels.com, and flagship Expedia, which they've all bundled recently to call One Key. So you can actually earn rewards on, say, Hotels.com and use them on Vrbo when you go to book a Vrbo. So it's really slick, and I think that's helping them build a little bit of a moat by combining all of their businesses together with this One Key and giving people One Key cash when they book on the platform. I personally use Vrbo just as much as I use Airbnb. I don't really discriminate between the two. I look at both when I plan my travel. Vrbo has a 21% market share in home share, so Airbnb obviously has the lion's share in that market. I don't know what their percentage is, but Vrbo has 21% of home share. So as Airbnb continues to grow, Expedia is going to continue to grow too because they also have market share there. I don't think this is going to be an Uber/Lyft situation. If you're familiar with those companies, you'll know that Uber is a massive company and Lyft is pretty tiny. Uber stock has done amazing. Lyft stock has done not so great. I don't think this is the same thing because Lyft is specifically rideshare, whereas Expedia is not specifically Vrbo. So I wouldn't invest in just Vrbo by itself, but Expedia Group I think makes a very compelling investment. Expedia and Booking together, ticker BKNG, have a 90% market share in online travel agencies, And Expedia has a 24% market share in all travel agencies. That means in-person and online travel agencies. So Expedia is huge. And to be able to invest in Expedia, hotels, and Vrbo all in one, I think is very compelling. Their CEO just stepped down, which, as you can see, maybe you can see in this chart here on the left, there was a big spike down not too long ago. That was actually when I re-entered the stock. I think it presents a great opportunity. It's a very cheap stock with amazing margins. So you can see their gross margins are 88%. This is a platform type business. So platforms often have great gross margins because they're only facilitating the transactions. Their valuation is very low, 1.5 times annualized sales with 10% revenue growth. I think that's amazing. So Expedia is actually the highest rated stock in my spreadsheet, if you can believe that. I don't know why the stock is so cheap. I think it's because travel is such a cyclical industry and the growth is going to go through these boom and bust cycles. So right now they're seeing 10% year over year revenue growth. But, if you look back, that growth has been rocky, especially if you look back in 2020 when people weren't traveling. So I think the reason the valuation is low is because this is a risky industry and it is going to be a cyclical industry. But at the end of the day, they're profitable. They have decent growth. They have a low valuation. They make a lot of money, good gross margins. I like Expedia. I'm invested in Expedia, and that's my second pick of the day. All right, third pick of the day is a stock that almost everyone is probably going to be familiar with, but that's Adobe. And the reason I added Adobe to this list is I think they're kind of being underappreciated right now. So if you look at the performance graph, you can see they've performed very, very well in the past year. They're pretty much at their 52-week highs, but I still think they have some room to run. So we see stocks like Palantir and Microsoft, these AI stocks that are just doing so well. Supermicro, which is just, don't even get me started on Supermicro. That thing is out of control. But these stocks that are related to generative AI are just doing so well just based on generative AI hype. And when I analyzed 5 different generative AI ETFs, Adobe was in every single one, and I just don't think they're seeing the same appreciation and respect that these other stocks are seeing. And sure, there's reasons for that, and we can get into that. But I think if you're bullish on generative AI even a little bit, Adobe is a no-brainer stock to own. They have generative AI applications in all types of media, so that's video, image, and music now. So they just announced a music generative AI platform, which is kind of cool. I'm excited to check that out. And they have a really nice SaaS business model. They're one of the top 2 biggest SaaS firms in the world, along with Salesforce, ticker CRM. And so what happened with Adobe recently is that OpenAI announced their Sora generative AI model, which generates videos based on a prompt. And I believe that people think that OpenAI is kind of encroaching on Adobe's territory, and that sent the shares down, I think something like almost 10% in one day, which is a lot for such a big company. So I believe that presents an opportunity. I actually added more Adobe shares on that dip recently. Adobe is just a great business, 88% gross margins again, that's not a typo, same as Expedia. They have $20 billion in annualized revenue, so the fact that they're even growing at 11% is just wild. To grow such a large number, 11%, they're making so much more revenue each year. And sure, they're eventually going to cap out and turn into sort of a value stock, but look at Microsoft. You're gonna see a lot of tailwinds. I always get those two confused. A lot of tailwinds going forward for this company. So this is one of the highest scoring stocks on my spreadsheet with a 13.4, and I think it presents a compelling investment. All right, let's talk about Palo Alto Networks. So Palo Alto Networks is a new one for me, ticker PANW. They're a cybersecurity company, and the thing that I like is that they're a leader in cybersecurity. They're diversified across multiple aspects of cybersecurity, not just endpoint, and they're twice as cheap as CrowdStrike. So CrowdStrike was my cybersecurity darling, and I actually sold CrowdStrike because I believe that Palo Alto is a better value today. So I don't like to sell stocks. I like the Warren Buffett method of hold a stock forever. But at a certain point, I had to look at CrowdStrike and say, this stock has appreciated so much. And while I do think it's an amazing company, I don't think the fundamentals are there to justify such a big run-up. And I saw Palo Alto dip, and I thought this makes a good switch. So what I did is I sold my CrowdStrike position, and I bought Palo Alto Networks. So they had a recent earnings dip. I think it was down 25% on earnings recently. And again, I think that presents an opportunity. They revised their guidance down, but they said that there's still a massive demand for cybersecurity. So to me, this is a short-term blip in the long-term cybersecurity thesis. I think everybody at this point understands the cybersecurity thesis. Every company has sensitive data that they need to protect. It's not an optional thing. If you get hacked, it's game over. So you really need cybersecurity if you're any kind of business that deals with customer information, which is pretty much every business. So cybersecurity companies have a massive TAM. Every industry needs cybersecurity. I think it's just going to keep growing as more and more things go online. It's really a no-brainer. I think everybody should own some kind of cybersecurity company. For me, it was always CrowdStrike. It did amazing. CrowdStrike was just such a winner. I finally moved that over to Palo Alto, and I plan to hold Palo Alto unless something seriously changes with the company, but I think that this is a long-term hold for sure. The other thing that I like is that it's in all of the cybersecurity ETFs I analyze. So that's CIBR, IHAC, Bug, Hack, and WCBR. One thing, if you're looking to get exposure to a particular theme, what I would suggest is to go out and find every single thematic ETF for that theme and compare them and find out what stocks are in every single ETF or what stocks you keep seeing pop up in the ETF. So that's what I did for Generative AI, and that's why I found that Adobe was in every single Generative AI ETF. If you look at the solar ETFs, you're always going to see Enphase, SolarEdge, Tesla. So if you're looking for good pure plays, that's a good way to do it. Cloud computing, you can look at cloud computing ETFs. One that I saw across every single one recently was DigitalOcean, ticker DOCN. Very small company, but it's one that I like nonetheless. So anyway, that's a bit of a tangent. But yeah, if you're ever looking to get exposure to a theme, look at all the ETFs, pull up a spreadsheet, write the tickers you see often, and mark which ones they're in. And if you see a ticker coming up in, let's say you analyze 5 ETFs, if you see that ticker in 4 ETFs, you know that's a pure play for that theme, and you know that you're going to get exposure to that theme with that company. All right, tangents aside, let's talk about the score of this company. So they have a price to annualized sales of 12. CrowdStrike is closer to 24. They have annualized revenue of about $8 billion, and they're still growing double digits, almost 20% year-over-year revenue growth. Gross margins are actually pretty much the same as CrowdStrike at 74. I love everything about this company's financials. I just think it's a no-brainer for me right now. All right, and please don't hate me. My final pick is Pinterest, and I know that's not the hyper-growth, cool, sexy stock that you would think, but I really think Pinterest is compelling right now. It's still super popular. My wife uses Pinterest almost every day. It's so funny. I'll look over at her on her phone, and she's always on Pinterest. And so people still use Pinterest. It's growing. They have almost 12% year-over-year revenue growth. Like I said here, the financials don't lie. So they have great margins. Their valuation's reasonable at 6 times annualized sales. And I think they have this network effect that will lead to margin expansion. So as more and more people begin to use the platform, it's going to get bigger and bigger reach. It's going to become more efficient. So their advertisers are showing a lot of loyalty, unlike Snap. So Snapchat advertisers are very fickle, whereas Pinterest advertisers keep coming back. So that shows that advertising on Pinterest works and is showing an ROI, unlike Snapchat advertising, which I don't think works as well. Pinterest has a super wide user base, so 31% of adults in the US use Pinterest. I think that's wild. And then they have a lot of integration with e-commerce, so you can do this kind of visual search and sort of this online shopping as you're scrolling Pinterest. If you see something, if you're unfamiliar with Pinterest, I hope I'm not, being condescending by explaining Pinterest. I mean, I'm not super familiar with it. So if you see something and you're searching for, let's say, bathroom decor, and so you search for, modern bathroom, and then you see a picture of a modern bathroom, and you hover over maybe the faucet, you can click on the faucet in some cases and go and buy that particular faucet they have in the picture. So it's really nice. It's a good way people see something and they say, oh yeah, I want that exact thing. Click the link, it's right there. So it's an interesting ad tech / e-commerce play that I didn't really consider until recently, and I think it's actually a good buy right now. So they had a recent earnings dip as well, but their future still looks solid. They're still growing. Like I said, good gross margins of 77%. They're not really spending too much, so they are profitable, and I just think it makes a nice investment going forward. It gets a score of 12.8, which is above my average of 11.5. So that means everything together, their margins, their valuation, their growth, and the revenues that they've already captured are pointing to an above average stock on my spreadsheet. So there you go. Don't discount Pinterest. I think it's got a lot going for it. So anyway, those are my 5 stocks, 5 on the 5th. I hope that I've given you either some new stocks or some new perspective on some old stocks, and I hope that this helps you in your investing journey. If you have any questions or if you have a suggestion for my next 5 on the 5th, please leave your suggestions in the comments below, and I'll respond to all of them. Thank you so much for watching my video, and hope you have a great day.